Welcome in, welcome everybody out there. I am Dion Rabouin, reporter for the Wall Street Journal. This is Market Takes. I want to thank everybody so much for being here with me on the YouTube channel. We are doing a very special edition of Market Takes for you today. This is a live stream. We are coming to you just an hour and a half, or about half an hour actually, after Fed Chair Jerome Powell finished his press conference. A couple hours after the Fed dropped its statement, one of the most consequential Fed meetings in quite some time. We just finished up. Markets have now closed for the day. We are going to talk about what the market thought about the Fed. We are going to talk about what Fed Chair Jerome Powell said. We are going to talk about the economy and the potential economic ramifications of this Fed decision. We are going to break all that down and talk about all that. I know you could have been anywhere in the world, but you're here with me, and I want to thank you so much for doing that. We are diving all the way in to the FOMC meeting today, the Fed Chair Jerome Powell press conference, and the market reaction. We are going to do all of that starting right now. So look, let's take a look right now at the stock market and how markets reacted. Markets just closing just about a minute ago here in the U.S. New York, the Dow ending up about 1%, the S&P 500 up about 1.5%, the NASDAQ up about 2.5%. If you saw right as the Fed statement was released, the market did not have a positive reaction. The Dow basically going straight down. But we saw a complete reversal of that after Fed Chair Jerome Powell started talking. I'm going to talk about what happened, what we saw, and why that was. Now, first, let's take a step back here and talk about how we got here and the news of the day coming into this meeting. Now, last week we had another one of these special sessions where I jumped on after the CPI, the Consumer Price Index report, and I said to all you guys, this report is a game changer. Anything that you had thought coming into this report, throw it out. The game plan, light it on fire, throw it in the trash can. And the Fed really did that. Now, the market had been pricing in a 50 basis point rate hike. That means the Fed was expected to raise rates twice as fast as it normally does. You saw around the end of last week, market expectations change. I think a lot of that was due to a report from WSJ's very own Nick Timmeros. Had a report that the Fed was rethinking that 50 basis point rate hike that they had baked into the cake last month coming into this month. Because of that CPI report, we're going to be raising 3 times as fast as normal at this meeting, and that's exactly what they did. So we got a 75 basis point rate hike. Like I said, triple the normal pace the Fed raises rates at and has historically done. The biggest rate increase since 1994. So today was a big deal. But that was all priced in. The market had expected that coming in, and what really we want to dive into is what we heard from the chairman, what we saw from the market's reaction to that, and what that means going forward. So look, let's dive in. Remember that CPI report showed inflation coming in at 8.6% last month. That was higher than 8.5%, which was in March, where we were supposed to have peaked. The idea was the Fed told us, well, inflation peaked in March, it's going to start coming down slowly, but you know, we're going to get there back to our 2% target. Well, May was higher than that, and so now we're back to square one, basically. So then after that, in addition to that CPI report, we got the inverted yield curve overnight coming into today. The 2-10 yield curve, which is a long-time predictor of recessions. You go check out my video on that. We did a video on that a couple months ago on why the 2-10 yield curve is such a great predictor of recessions. We get into and explain all of that, but that yield curve basically inverted overnight. You saw the 3-year yield well above the 10-year yield and the 3-year yield well above the 30-year yield, which means if you're an investor, you're getting paid more to loan the government money for 3 years than you are getting paid to loan the government money for 30 years. That's just incredible. And again, these are things that predict a recession because it suggests that the money, the value of money or the need for money now is much greater than the need for money in the future. That tends to say that investors are bearish. There's worries about recession. You also got the Atlanta Fed's GDP Now report suggesting that we are going to get 0% growth in the second quarter of this year. That's what we're in right now. If we get 0% growth, or if we get below that 0% growth, even 0.01%, that basically puts the US in recession because we had negative growth in the first quarter. So today's meeting was a big time meeting, and Fed Chair Jerome Powell, I don't know if he rose to the moment. Look, the stock market really liked what he had to say. Like I said, the NASDAQ up 2.5%. I think the key to that was what the chair said when asked about really the Fed's priorities. He said, we need to show resolve, as in the face of inflation, we need to show resolve, get inflation back down, but we also need to be flexible. Well, flexible means that maybe we're not on automatic pilot. Maybe rates aren't going to continue to go up by 75 basis points each meeting. Maybe the Fed is not determined to do whatever it takes. And look, I really think today's meeting was a chance for Fed Chair Jerome Powell's whatever it takes moment on inflation. When we had the COVID-19, lockdowns and economic shutdown, Fed Chair Jerome Powell came out and very strongly said, look, we're going to do what it takes for as long as it takes. If that means $120 billion a month getting pumped into the economy, rates down low, negative real rates for a long time, we will do this for as long as necessary, and made it clear that we will do what it takes for as long as it takes. I thought today's meeting required a similar response from the Fed chair, and it didn't feel like we got it. He said the right things. He said the words, inflation's their top priority. We need to show resolve. We've got to get market prices under control. But there was no, what I really would have thought the Fed chair would do here is kind of turn directly to the camera. He had a very long speech today, and he spoke for a while before he took questions. And I really thought he would have taken a chance to kind of look at the American people and say, we will do whatever it takes to get inflation under control. We have got this. We are going to use all of our tools, and we are going to get inflation under control, and we're going to get it under control quickly, as fast as we can. They love that word, expeditiously. We're going to get inflation under control expeditiously, and I really felt like the Fed chair didn't do that today. And it's interesting to see why he didn't. He also sort of, again, hedged, said we're going to be flexible, we're going to be nimble, we're going to be, if inflation isn't really wiling out of control, we're going to be flexible and maybe go back down to 50 basis points, maybe even just 25 basis points, maybe even stop raising rates, right? So they raised their projections, they lowered their projections for the economic growth, raised projections for inflation, but there wasn't a moment for me where Fed Chair Jerome Powell looked in the camera and said, America, we got this. And I felt like that's what was needed today. So anyway, you saw the reaction throughout the markets, bonds coming down, stocks rising high, the dollar falling down. Again, I think a lot of that was just in reaction to the move that we've seen since that CPI report last week. Bond yields have just gone absolutely through the roof. You had the 10-year yield going up to 3.5%. That's the highest it's been in a long time. And I think today was just a bit of a relief rally. A lot of folks saying, okay, the Fed is willing to be flexible, willing to be nimble. They're not dogmatic about raising rates. Well, it's time to buy because things aren't the worst case scenario. And I think that's what we saw. Look, let's get into a little bit of the difference between the June and the May statements. The biggest difference between the statements was the committee said that it is strongly committed to returning inflation to its 2% objective and replaced the phrase with appropriate firming in the stance of monetary policy. Right? It was a small change, but they're saying that we are strongly committed to firming the stance of monetary policy. And I thought that was probably the biggest change in the statement that we saw in between last month and this month. Strongly committed to returning inflation to its 2% objective. Again, it's there, it's in the statement, it's in black and white. You can't deny that they said it, they did say it, but you didn't see the Fed chair come out and kind of bang the table and say, we're going to do this and take it under control. Interesting note, Esther George, a longtime hawk, hawks meaning folks who like rates higher because they're more worried about inflation, was the one person to dissent on the 75 basis point rate hike. She has long been known as, when the Fed was cutting rates, she dissented. When the Fed wanted to hold instead of raise, she dissented. This has been her thing for a very long time. And today, Esther George dissented and said, no, I think we should only raise by 50 basis points. Personally, I think she's trolling the committee and trolling Fed Chair Jerome Powell ahead of her retirement. That's just me. It's one man's impression. Don't take me too seriously. The summary of economic projections, another big piece of this. Like I said, they raised their expectations for rate hikes. Previously, the Fed was saying we're going to get rates up to about 2.5% to 3% by the end of the year. Now saying we're going to get rates up to about 3%. Every voter on the committee said that rates will be at least 3% by the end of the year. 5 voters see rates above 3.5% in 2022. In 2023, every single person on the committee saw rates above 3.5%. Again, this is meaningfully higher than rates were projected to be the last time the Fed released summary of economic projections. What that means: higher interest rates, higher rates on a mortgage, higher rates on borrowing for a car, higher rates on your credit card. All those things are going up. If you've got a home equity line of credit or a home equity line of credit, not a loan because you got that in one installment, but if you've got a home equity line of credit, the rate that you were paying yesterday is not the rate you're paying today. That rate has gone up by 75 basis points. And the projection is that these rates are going to stay higher for a longer period of time. You had 5 voters actually saying they expected the rates to be above 4% in next year. So that's saying rates are going to be higher for longer, and more of the committee saying that they projected that. The Fed seeing the U.S. jobless rate. Now, this was on the other side of that. They expect a higher unemployment rate this year and next year and into 2024. The unemployment rate remaining about 4%. So the Fed, again, saying they project that soft-ish landing where we are going to see job losses, we are going to see folks lose their job, we are going to see more layoffs and firings, but not at a large scale. And again, unemployment will remain at those very low levels, 3.7 to 4% through 2024. And Fed policymakers said they expect to cut rates in 2024. I think the biggest thing from the actual press conference, right? Because you get the statement, it comes out, and then Fed Chair Jerome Powell comes out and defends and explains the statement. Really, I thought what Powell said about the U.S. economy and the consumer, again, giving that we've seen today U.S. retail sales coming in negative 0.3% last month, while inflation rose 1% last month. So prices rose by 1%, but overall spending declined by 0.3%. That means you're seeing a significant pullback of American consumers. Despite that, and despite the Atlanta Fed's GDP Now measure, which is, again, it's the Federal Reserve's own measure of expected GDP for the second quarter, that came in at 0 after negative 1% in the first quarter. Fed Chair Jerome Powell still saying that the U.S. economy is strong and that the consumer is doing well. That's not what the numbers today told us. And again, he's been in a meeting all day. You got to give him that. But that is clearly not what the numbers told us, and Fed Chair Powell coming out and just saying, hey, you know what, things are good, still trying to reassure us that the economy is strong, the consumer is doing well. I thought that was very interesting and certainly a point that I took away watching from that meeting. So again, this is our live stream Market Takes. Thank everybody who's tuning in right now with us on the live stream on YouTube. Really appreciate you guys for tuning in right now. We are continuing talking about what we learned from Fed Chair Jerome Powell, from the summary of economic projections, and from the Fed and the market's reaction. Look, another thing that I think may have flown under the radar given the market's reaction was Powell's continued use of the word restrictive when talking about monetary policy. Restrictive policy means policy that's so high, where interest rates are high enough that they restrict the economy from growth, that you are trying to rein in demand. And they had really shied away from using that word. They only kind of accepted using it here and there last month at the last policy meeting. You saw Fed Chair Powell kind of pepper it in there, say, okay, yeah, we might get to restricted levels. Today, restrictive, restrictive, restrictive. We are raising monetary policy to restrictive levels. We are going to be, monetary policy is going to be restrictive going forward. Again, he said that, but he also said, but we're flexible. And the market really liked flexible. So I think there was a lot of restrictive and a little bit of flexible, and the market really chose to focus on flexible. I think that was probably the biggest, or my biggest takeaway at least, from this meeting. Now, what to watch for in the minutes that are coming out on July 6th. We're going to get minutes from this meeting. We may find out why Esther George dissented. We may find out whether this was really, everybody was on board with this 75 basis point hike. Again, 3 times the rate that they normally raise rates at. Was everybody on board? Was there a lot of disagreement? What did the Federal Reserve really say about this? The FOMC, the policymaking committee, how on board was everybody? What were some of their worries? What were some of the concerns? And what were the things that were said to get everybody moved from 50 basis points, which is what they said they were going to do last month, to 75, which is a significant increase for the economy. Clearly, the biggest takeaway, if you're going to step back away from this, just looking at this meeting, right? Coming into this meeting, I think the biggest takeaway was that investors believe and trust the Fed to do exactly what they say they're going to do, which is have a soft landing, slow demand, but really allow the economy to continue growing and not reduce policy so much that they can bring in inflation and they can continue to keep the economy on track. If you look at 5-year, 10-year, 30-year break-even rates, those all declined after we got that CPI report last week on June 10th. Those are investor expectations of the economy. And again, investors are betting real money on these expectations. Those all came in and showed that investors expect longer term inflation is going to come down. But if you look at the Treasury market, that's also investors, and those yields jumped through the roof, jumping about 40, 50 basis points in just the last couple of days. Those are historic size moves. So investors are saying long term, we think that inflation is going to remain in control, that the Fed has this under control, and that they're going to keep inflation down and near that 2% target. But if you look out at the real economy, if you look at what's happening with consumers, what's happening with companies, prices continue to rise higher. And we see that, wage increases are still running at 5%. Those are increased. PPI, producer prices, that came in nearly 11%. We just got that report yesterday. So we're also seeing consumers' expectation of inflation rise to new highs. We saw the University of Michigan's Consumer Sentiment Survey said the public's expectation of inflation 5 years from now jumped to 3.3%. That's up from where it was in May. And inflation a year ago jumped to 5.4%, up from its previous levels as well. The New York Fed's inflation expectations also jumping to 6.6%. So these numbers, and again, even the 3-year inflation expectation jumping to 3.9%, near 4%. This shows that consumers, businesses do not believe that longer term inflation expectations are going to be reined in. They don't trust the Fed to be able to do what they've said they're going to do. And that's a concern that I don't think Fed Chair Jerome Powell really hit as hard as I think he needed to hit it today. So that's definitely big. And I think will be one of the big takeaways as we move forward throughout the rest of this year as we look back on this meeting. Hey, look, I am Dion Rabouin. This has been our very special market take session looking at the Federal Reserve's meeting today. And can they tame inflation? Can the Fed tame inflation? That's the big question. Clearly, the market still has confidence in the Fed. You saw it with what happened in the bond market, what happened in the stock market, what we're seeing in some of these more complex markets like break-evens and tips and things like that. But the consumer and business owners, that looks to be a different story. And we are seeing continued disbelief, continued higher inflation expectations. And that was actually one thing that Fed Chair Jerome Powell pointed out himself. He said, we saw these numbers on the University of Michigan Consumer Sentiment Index, and that worried us, and that was one of the reasons that we raised rates by as much as we did. So keep an eye on those inflation expectations from consumers. Obviously, the Fed's watching. I'll be watching. I hope you'll continue watching those, and I hope you'll continue to watch what we've got going on right here on Market Takes. That was a little bit of shameless self-promotion, but I appreciate y'all tuning in with me. Anyway, we're gonna wrap that up here. I will be back with you guys for a regularly scheduled edition of Market Takes next week. We will not be on Monday, that is Juneteenth, brand new federal holiday that WSJ workers get the day off. So I will not be with you on Monday, but we will continue to do this live stream going forward. I hope you'll tune in and be with us there. I'm Dion Rabouin for the Wall Street Journal. Thank you for tuning into Market Takes, and I hope you'll stick with us and come back again.